Hi everyone, today we'll talk about 3 best recession investments to own. A lot of analysts nowadays are saying that we are heading into a recession, and some of them are saying that we are currently in a recession. But a lot of people do not know the definition of a recession. According to the Google definition, a recession is considered a period of temporary economic decline during which trade and industrial activity are reduced, generally identified by a fall in GDP in 2 successive quarters. So our GDP for first quarter of 2020 decreased at an annual rate of 4.8% compared to the increase of 2.1% in the fourth quarter of 2019. Our second quarter of 2020 is expected to fall even more. So this, technically, according to this definition, we are heading into a recession. But is this going to be a deep recession? That remains to be seen in the next coming weeks. Before we go on, please like this video, hit the like button as hard as you can, and subscribe to the channel so you don't miss our future videos. The first recession investment to own is Walmart. People's favorite staple is Walmart. In times of recession, companies such as Walmart that sell low-priced merchandise normally perform better than those with expensive products. A big portion of their business is in groceries, and people need to eat. They need groceries regardless of the direction of the economy. So in a low margin business like groceries, it's all about volume, and Walmart is pretty much doing everything they can to boost the value. They are rolling out delivery, they are doing curbside pickup, and the staff of Walmart is just doing everything they can to help boost the volume. Even though the stock has been trading at all-time highs because of all of these factors we just mentioned, we believe that there is more upside with Walmart. Walmart is strategically positioned to do well, either we are in a recession or non-recession environment. Its e-commerce sector continues to gain a lot of attraction. Just last year, the e-commerce revenues increased exponentially. No wonder that Walmart delivered a total return, this is price plus dividends, of 20% in 2008 during the Great Recession, while the S&P 500 had a loss of 37% with dividends included. For the past 12 years, Walmart stock has been outperforming the S&P 500, especially during these rough economic times of 2020. As we can see in the graph, the Walmart stock has been really doing much better than S&P 500. If we take a closer look at Walmart's income statement during the Great Recession, we can clearly see that revenue, net income, and earnings per share were drastically increasing during those recessionary times. This was a good indicator that this company is a good investment even during recessionary times. We see similar trends if we take a closer look at Walmart's income statement for the past 3 years. We can see that revenue, net income, and earnings per share have been steadily increasing during these past 3 years, which is a really good sign for the company. Walmart's price to earnings ratio as of May 8, 2020 is 24.89. According to our price to earnings ratio standards, this is a bit too high. It would be nice to see this number go at around between 15 and 20, because this would give us a good opportunity to buy this stock at a much better value. If we take a closer look at Walmart's balance sheet during the Great Recession, we can clearly see that between the year of 2007 and 2011, Walmart was keeping cash on hand at around $7 billion. We can see from this table that the current ratio was ranging between 0.8 and 0.9. The current ratio is the number that we get by dividing the total current assets by the total current liabilities. We would like this number to be a little bit higher than 1 at least, because that would technically mean that the total current assets are higher than total current liabilities, which means the company can meet its short-term obligations easily. But Walmart's balance sheet of 2020 shows a drastic increase in cash on hand for the company. They went from 6.8 billion in 2018 to 9.4 billion in 2020. However, the current ratio seems to relatively be the same. It's ranging between 0.75 to 0.80, just roughly the same as during the Great Recession. This is not necessarily a good thing because the company needs to increase this current ratio at least above 1. Walmart needs to increase its liquidity ratio so it is able to pay short-term obligations without any single problem. Walmart has a great dividend growth history of 45 years. The dividend yield for this company is 1.77% and the payout ratio is 43.81%, which is a really good payout ratio. For those who do not know, the payout ratio is the percentage of earnings that is paid to shareholders in forms of dividends. So the amount that is not paid to shareholders is kept by the company to pay off debt or to reinvest in other essential operations. So according to this table, we see that the table to the right shows the dividend increases that the company did during the Great Recession. The company has been always increasing the dividend. As it can be seen in the past 2-3 years, it went from 0.52 to 0.54 cents per quarter per share. The second best recession investment is the 3M company. This is a diversified technology company. This company manufactures a different number of industrial and consumer products. The company has been getting a lot of media attention lately during this healthcare issue that we are currently facing with its N95 face mask. The company produces a lot of daily life essentials, so these products that we use in our daily lives are needed no matter if we are in a recessionary or non-recessionary period. As we can see in this graph, 3M stock has been slightly outperforming the S&P 500 during the Great Recession, so that's in the beginning of 2009. And then in the next 10-11 years, the stock greatly outperformed the S&P 500. But then the 3M stock had a small crash in the mid of 2019 where it fell to the same levels as S&P 500. Recently, the stock has made a quick V shape since it has made the media a couple of times trying to produce all the necessary equipment for this healthcare issue that we are facing right now. So the S&P 500 currently is a little bit outperforming the 3M stock. The 3M stock price crashed on March 21st to really low levels. It was trading at around $100, $110 per share. That's the date actually when the whole stock market crashed as well. Since then, the stock has been showing a quick recovery. It's almost a V recovery, and right now the stock is trading at around $150 per share. The last time the stock was trading at these levels was back in January of this year, right before this whole healthcare issue started. If we go back to the recessionary times of 2008, the 3M income statement shows a really good stability of the stock during the recessionary times. The revenue during that time was stable and steadily increasing between 2008 and 2011, as it can be seen in this table. The bottom line, or net income, was really stable during those times, whereas the earnings per share was steadily increasing between 2008 and 2011. If we look at the income statement for the past 3 years, so for 2017, 18, and 19, for the 3M company, we can see that the revenue has been sitting at around $32 billion for the past 3 years. Net income has been sitting between $4.5 and $5.4 billion. Earnings per share is at around 8. It is worth mentioning that the current PE ratio of 3M company as of May 8th of this year is sitting at around 16.7. This PE ratio shows that the stock is at a very fairly valued levels, so it's worth starting a position or adding more to a current position at these levels. If we look at the balance sheet of 3M company back during the Great Recession, we can see that the company doubled their cash and cash equivalents. So from 2007, which was 2.5 billion, to 2010, which was 4.5 billion. What's worth mentioning is that the current ratio was sitting at a really good level during these times. So the current ratio was ranging between 1.5 and 2.3 between 2007 and 2010, meaning that their total current assets were double their total current liabilities, and the company was able to meet any short-term obligations during that time. However, if we look at the balance sheet of the 3M company between 2017 and 2019, we can see that unfortunately their cash and cash equivalents has been decreasing from 4.1 billion in 2017 to 2.4 billion in 2019. What's worth mentioning here as well is that the current ratio for this company for the past 3 years has been steadily decreasing, meaning that their ability to meet and pay their short-term obligations has been getting into a rough position. However, it's worth mentioning that the 3M current ratio for the 3 months ending on March 31st of 2020 was at 1.65. This shows that their total current assets might have been increasing, or their total current liabilities might have been decreasing in the first quarter of 2020, which is a good sign considering that we are getting into a recessionary time. 3M company has shown a really great dividend history with a dividend growth of 61 years. Their current dividend yield is at 4.03% and the payout ratio of 73.43%. It is worth mentioning that this payout ratio is very high compared to our standards. We normally would like to see a payout ratio of 50 or below 50. As we can see from the table to the right, this shows the dividend growth during those Great Recession times. We can see that between 2008 and 2010, the company has slowly and steadily increased the dividend. We can also see for the past 3 years that the dividend has been slowly increased from 1.175 to 1.47. Based on its dividend history, we believe that the 3M stock will increase the dividend in the next coming quarters, even though we are facing and we're entering into some recessionary times. And the third or final best recession investment is the big dog Johnson & Johnson. So people don't get to choose when they want to get sick or what illness they want to develop. People just get sick. But this is what Johnson & Johnson does. It helps you with all the necessary medication. Johnson & Johnson J&J is a relatively guaranteed investment in any economic environment. Johnson & Johnson is a big conglomerate that does research, it develops, manufactures and sells all different kinds of products in healthcare worldwide. It operates in 3 different segments: consumers, pharmaceuticals, and medical devices. The consumer segment offers baby care products, oral care products, over-the-counter medicines, allergy products. The pharmaceutical segment offers products in different therapeutic areas, including immunology, infectious diseases, neuroscience, oncology, pulmonary hypertension, and cardiovascular and metabolic diseases. And the last one is the medical devices segment, which provides orthopedic products, electrophysiology products, diabetes care products, vision care products, and sterilization and disinfection products. So in one word, Johnson & Johnson offers you anything related to medical devices or anything that has to do with body care and facial care. Therefore, at this point, let's start and analyze the Johnson & Johnson stock and see if this stock deserves to be in top 3 best recession investments. But before we go ahead and do that, please stop here for a second, smash that like button. It really helps the video get to the rest of the YouTube community. Johnson & Johnson stock price has way outperformed the S&P 500 for the past 2 decades. We can see that during the Great Recession of 2008-2009, Johnson & Johnson, the red line, is way higher than S&P 500, and it was trading way higher than S&P 500 for the next 12 years. The stock price of this company crashed on March 21st. That's with the rest of the stock market. However, since then it has shown a drastic recovery, and this is a very nicely shaped V recovery, and this once again shows you the importance and the strength of this stock and this company during recessionary or tough economic times. Right now the stock itself is ranging at around $150 per share, and that's equal to the same level that the stock was trading at in January levels. If we look at the income statement of Johnson & Johnson during the 2008 Great Recession, we can see that the revenue between 2007 and 2011, it was increasing steadily. That the net income, on the other hand, was going up and down between 2007 and 2011. So in 2007 we saw around 10.5 billion, whereas in 2011 we saw a 9.7 billion in net income. Earnings per share was drastically increasing between 2007 and 2010, but we saw a slight decrease in earnings per share in 2011. The past 3 years for Johnson & Johnson, so 2017, 18, and 19, have been great in terms of revenue, net income, and earnings per share, since the company saw a drastic improvement and an increase in revenue, net income, and earnings per share. It is worth mentioning that the Johnson & Johnson P ratio as of May 8th is sitting at around 16.75. This is a good point for us to enter into the stock. Whenever the P ratio is below 20, we start buying into companies, considering that other criteria are met as well. At 16.75, that seems like a reasonable buy for the company. If this P ratio goes lower, we should start buying even heavier. Looking at the balance sheet of Johnson & Johnson during the Great Recession of 2008, we can clearly see that their cash and cash equivalents tripled within 3-4 years. So from 2007 to 2010, it almost tripled. We also see that the current ratio, so the total current assets to total current liabilities, increased drastically. So it went from around 1.5 to 2 current ratio. However, if we look at the balance sheet for the last 3 years, so 2017, 18, and 2019, we can clearly see that their cash and cash equivalents has been sitting at around $19 billion for the past 3 years, whereas the total current assets to total current liabilities has been actually decreasing, meaning that their total current liabilities are increasing at a higher rate than their total current assets. Even with this current ratio, the company is still able to meet its short-term obligations. Johnson & Johnson has a long history of dividend growth for the past 57 years. It has a payout ratio of 52.37%, which falls under the acceptable range, and a dividend yield of 2.74%. The table to the right shows the amount of dividend the company has given out to its shareholders during the Great Recession. As we can see, it has been increasing during that time, and for the past 2 years the company has also increased the dividend, and according to the latest statements, the company will keep increasing its dividend growth in the next coming quarters. Based on this thorough financial analysis, we believe that these 3 stocks are great investments during a recessionary time, as we saw that they did really good during the Great Recession of 2008. Please keep in mind that we are not recommending or suggesting any of these stocks. This is not a financial advice channel, nor do we intend to be one of those. We are just sharing our opinion, thoughts, and research in the stock market. Before you leave this video, please hit the like button, subscribe to the channel, and leave a comment down there regarding this issue. We will gladly respond to any of the comments you guys have.